Presidential Wealth Management. Have reverse mortgages gotten a bad rap? And how can you find out if a reverse mortgage is right for you? That and a lot more on reverse mortgages in this Eagle's Nest webcast.
A reverse mortgage is a type of loan that enables you to turn a portion of your home's equity into cash. The loan is either repaid or the home is sold to pay off the debt in a reverse mortgage. Reverse mortgages date back to 1961, and the number of people over 62 who qualify for reverse mortgages is expected to double over the next several decades. Reverse mortgages can be a very valuable tool when used correctly and for the right reasons. The best way to ensure that is to educate yourself. Let's start that education now with Lauren Levy. Lauren is a senior wealth manager here at Presidential Wealth Management, and he also has been a mortgage broker for almost 20 years. Lauren, right here, give me a short description of the most common misconception about reverse mortgages.
Sure. I think there's really two, Keith. I think one is that they are way too expensive, and therefore I would never want to do one just because I've been taught not to pay fees on things, and therefore I just why would I want to do one and spend a lot of money? And I think the second biggest misconception is that the bank takes ownership of the home, and at some point, someone's going to get kicked out onto the street and be homeless if they, because of the reverse mortgage.
That's the worst fear. We're going to lose the house, right?
That's right.
Fascinating. Lauren Levy with answers to your questions about reverse mortgages coming up. I'm Keith Weinman with Taylor Leary from Presidential Wealth Management.
Fantastic. This is going to be a fun one. Since we started doing this, Keith, this has been a conversation that you and I have had on a number of occasions. And that is, we got to get Lauren on here because he has such great insights because he's kind of got 2 feet in both sides of this. He's a mortgage broker, very intelligent about that, but then he's also an advisor. And so he can understand how those two things are interconnected, where a lot of the times, an advisor might not understand what a reverse mortgage does or how it might help their clients. And then on the other side, a reverse mortgage specialist might not understand how it fits into a financial plan. So today, I hope that we can connect the dots and give a little insight to our audience on how to really understand what a reverse mortgage is and really might give some clarity on how it might be incorporated into a financial plan. We're not going to, necessarily get to the bottom of whether it's good, bad, or indifferent to your situation, but we'll at least give you some ideas on how it works and what you might get out of it. So with that said, we want to make the most out of today's presentation. And we'll start by just giving you a kind of the intro to how to work with us and how to engage with us today. So number one is on the right side of your screen, you'll notice that there's a couple of different things that you can actually click on. The first is going to be the chat feature. So the chat feature is a great way to send in your questions as they come. We know that this topic is riddled with a lot of questions, a lot of unanswered questions, and maybe some misnomers about what's going on in the reverse market or reverse mortgage market. So use the chat feature to ask questions. There's no bad questions. And the other part of that is that it's also a private chat feature. So if you're feeling a little bit hesitant about maybe if this is a stupid question or something like that, by all means, ask the question, because if you're asking the question, there's a darn good chance that there's a lot of other people asking the same question. So you'll be doing all of us a favor. The chat feature is private, so it's only going to go to the 3 of us. It's not going to be on the public forum. So with that, use the chat feature to ask those questions, and we'll do our best to get to them before the end of the hour here. We'll also introduce some polls. So I'll kind of tee those up. We've got a couple polls today. Great way to get direct feedback from you as it relates to questions that we have about what's your experience been with a reverse mortgage, things like that. So use the chat feature. I'll tee that up for you and let you know when we're asking for the polls. And then finally, a way to connect with us. So use the offers tab to schedule some time for a one-on-one call with one of our advisors to see if you'd be a good fit for our office, and vice versa, if we would be a good fit to work with you, or if you have questions on how a reverse mortgage might fit into your financial plan. So without further ado, I'm going to introduce the very first poll today and just get that started. So I'm going to publish this poll, and it is, how do you feel about a reverse mortgage? I've got 5 answers. So this is the most answers that we've had up to this point. So I've only heard bad things. I've heard they aren't good, but want to know more. The third answer is, I don't know enough to make a final decision. I've heard they're great. And the last one is, what's a reverse mortgage? So with that, Lauren, I got to ask, in your words, what is a reverse mortgage?
So simply said, a reverse mortgage enables the homeowner to access the equity in their home without having to make payments on the money. So people are used to thinking, well, I can get a mortgage, or I can get a home equity line of credit, or a second mortgage on my home to access the equity. But those types of loans require that you have to make payments on them and pay them back over time. A reverse mortgage does not require payments to be made.
Okay, that seems reasonable. So let me understand, how does it work? So let's just say I want to come to you and I'm like, yeah, I want to reverse. How does it work, and what are the rules? Kind of give us some of the kind of the basics, I guess you could say, of kind of where to start and how one of these things kind of works for you.
Okay, sure. First of all, you wouldn't qualify because the number one thing is you have to be 62 years old.
Okay.
Okay, and that applies to anyone that plans on going on the loan. So one of the things we have to be very careful about is if a couple comes in to meet with me and one of them, let's say, is 66 years old, but they married a younger spouse who might only be 58. Sometimes you'll see someone who wants to do a reverse mortgage because they want the husband or whoever the older partner is to be able to retire and be able to do things with the younger spouse while they still can. The challenge there is that younger spouse cannot be on the loan because they're not 62 years old. And that can create a problem down the road, which will lead me to some of the negatives you hear about reverses with a spouse being evicted. But in a nutshell, the reverse offers many different opportunities and different ways to withdraw equity from your home without having to make a payment back. The term reverse is what people don't understand a lot, because on a regular mortgage, you just refer to it as a mortgage. But technically, a regular mortgage that we're all used to is a forward mortgage, meaning you're making payments down, you're going forward, you're paying the house off. A reverse is just the opposite. You're never paying the house off. In fact, you owe more and more and more every month that goes by. And God willing, you live long enough, you could owe more than the house is worth at the end, if that works out that way.
So the IRS, as they like to do, and any sort of government entity likes to do, they like to muddy the waters. A reverse is what you and I would call it in our vernacular. But what's the name that that you might see on a government website?
So you're going to see typically you're going to see the term HECM, HECM, which stands for Home Equity Conversion Mortgage. Okay. That's what you'll find typically when you Google it or research it on the internet. That's the technical term for a reverse mortgage, a home equity conversion mortgage.
Excellent. And when it comes to a homeowner, I guess, who might be a good candidate for something like this initially?
There's a lot of good candidates, to be honest, but what you have to have is a decent amount of equity, first and foremost, beyond being 62 years old. Reverse mortgages technically have a component of life insurance to them, where they have actuarial people that set the percentages that they will allow you to borrow based on your age. So the older you are, the higher percentage of the value of your home you can borrow. Now, I will tell you that 2 or 3 years ago, there was a change made and people cannot borrow as much as they could back then. That's because they were worried about the reverse mortgage program. They didn't want it to lead to be a taxpayer bailout because people were living longer. There was also some natural disasters that had happened that were making people walk away from flooded homes, for example. And so there were some things that got in there where the government didn't want to have to get to the point where the taxpayer had to bail out the program. So they tightened it up a little bit, and now they don't lend quite as much at each age as they used to. But they're still a very valuable tool for people that have the equity.
Lauren, moving forward, I don't want to get too far ahead before we go back to something that you mentioned that I think is a very important point that addresses one of the most common fears about reverse mortgages. And that is, I've come to believe in learning from you, in prep for this program, that I would think that it is always best when there is a couple to have both people on the loan, and for some very, very important reasons, correct?
Yeah, I mean, one of the things that you'll read about or you'll see on the news about a reverse mortgage when you talk about the negatives, we talked about the cost, is you'll see someone get a hold of the local news and they'll point out that some typically older lady was being evicted from her home due to a foreclosure because of a reverse mortgage.
Wow.
When I see that, immediately my brain goes to 5 places. There's only 5 reasons that is happening. Number 1, she didn't take care of the home. That's one way you can violate a reverse mortgage. She didn't pay the property taxes. She didn't pay her homeowner's insurance. She converted it into a rental property. Or the last one is she was not on the original loan when it got taken out. And that is where I think the bigger problem comes into play, because only the person or people on the original note when the reverse mortgage is taken out are protected from eviction, from foreclosure. Okay, so if you have, like in the example I used before, a 66-year-old person with a 58-year-old spouse, what they'll do to try to get a reverse mortgage is the term is called quitclaim deed. They will remove the younger spouse from the title of the property, go ahead and do the reverse mortgage on the older person, and then they think, well, we'll just quitclaim deed the spouse back on after, and they'll be covered. They'll have half ownership of the house. They will have half ownership of the house, but they may have half ownership of a house that has no equity left at the end. When the older spouse goes to assisted living or nursing home, or God forbid passes away, the younger spouse at the time thinks, well, I can just stay there forever too. We have a reverse mortgage, they can't kick me out. Well, they weren't on the loan in the first place.
Yeah.
So they are subject to foreclosure or any of the other remedies like selling the home and paying off the mortgage or refinancing it into their own name. But typically, they don't find this out or remember till they're 90. And at that point, they're on a fixed income and they can't qualify to get a regular mortgage. So they either have to sell the house or leave and let the bank sell it. But it's typically because they weren't on the loan in the beginning.
So this is really fascinating. We actually got a question from Raj. And Raj, thank you so much for sending in your question. This is directed at you directly, Lauren. And he said they got a reverse mortgage in early 2016. Is it time to redo the reverse as our property values have gone up? So that's the question. And one of the things that we talked about the other day is just what's going on in this market right now. So I guess what it comes down to is, can you refi a reverse?
So the answer is absolutely, you can refinance a reverse. Okay, that's the easy answer. But the honest answer for Raj is, it might be time to take a look at it, but is it time to redo it? I really don't know. And the reason I say that is because if Raj took out his loan 2 or 3 years ago, odds are it was under the old parameters, the old loan to value parameters based on age. So my gut tells me that back then they were probably lending more money at his age than they are now. So the reason you would refinance a reverse is because your home has gone up in value and you think now you're older, I can access a higher percentage of the value of the home now. But if they've changed the way they do the loan to value calculations, then you might not be able to access any more. You might be able to access maybe even less than you could have 3 years ago. Because you remember 2 or 3 years ago, now you haven't made payments the whole time through. So you owe more on the house now than you did back then. And they've changed the charts. So the question is, I don't know. It's worthwhile maybe to take a look. It's a computer formula. We plug in the date of birth, the current value of the home, and what's currently owed. And the software spits back at us and tells us if there's any equity left to do anything with or not.
Let's go backwards again to a question that will occur to most people before they start the education process on should they or should they not engage in a reverse mortgage, and that is the reasons for doing a reverse mortgage. Lauren, and with your experience, I'll bet there are reasons that our viewers are totally unaware of, ways that reverse mortgages can be responsibly used for in the best interest of the person taking the loan, reasons that we're totally unaware of. So give us the long versions on these, because each one of these reasons, I'm sure there are stories with them.
Well, all right. Thank you for saying give us the long version, because I was going to tell you this can be a long answer and I can go as long as you want.
That's good.
So the first thing to understand is reverse mortgages, you have to change your mentality, okay? People have been trained through the mortgage crisis of 2008 and 2009, for example. There's a term out there called an adjustable rate mortgage. That became almost like a voodoo term through the recession of 08 and 09, because everyone blamed the recession on these subprime adjustable rate loans that were out there. And nobody ever wants to deal with an adjustable rate loan. So now when we go to do mortgages for people and we use that term, some people go, oh, no, I just want a fixed rate loan. I don't want anything that can adjust on me. On a reverse mortgage, you have to understand that a fixed rate loan does not allow for any bells and whistles or additional features of a reverse. So a fixed rate loan will let you basically take out as much money as they'll allow at the closing. You take out whatever you can get and it's done. That's what you get. So we use it for people who are just looking to take a lump sum out one time, or let's say someone qualifies to borrow $225,000, but they owe $225,000 on their current house, and then they just want to pay off the mortgage and move on with their life. That's when we use a fixed rate loan. An adjustable rate loan on a reverse offers many, many other features. So we use that for someone who either doesn't owe anything on their house currently, or in my example where they qualify for $225,000, but they only owe $100,000. A fixed rate's just going to pay off the $100,000 and you're done. Maybe give you some extra cash on the side. An adjustable rate will say, okay, we're going to pay off the 100, but now we have that other 125 available. And what do we want to do with that? We can leave it alone and it becomes an equity line that we can tap into down the road. If our hot water heater goes out or a furnace or AC goes out, or we need to pay a deductible on an insurance claim, we can tap into that equity line. We have an opportunity to create a pension for life. We have an opportunity to create a pension for a set period of time. Or we have the option to utilize all of these at the same time. So let me give you just a quick anecdotal story here. I did a refinance, a reverse mortgage for a gentleman. He was 84 years old. His wife was 79. They lived in Thornton. They had about a $400,000 or $500,000 home, and they didn't owe. Can't remember if they didn't owe anything or they owed less than $100,000. So they qualified based on their age for about $250,000 of this $500,000 house. We used the younger age. Well, we came in and we just paid off the mortgage that was left. And when he first contacted me, he was saying that if they could just generate an extra $500 a month, their retirement would be revolutionized. They'd be golden. Well, as him and I got to talking, and as the loan was working its way through to closing, I told him originally I could get him $1,200 a month for the rest of his life. He was like, wow, that's amazing. Then he determined he doesn't need $1,200. What he wanted to do was pay off his car to the tune of about $25,000, which the loan did. He wanted to give his grandchildren one last nice Christmas, so he asked for about 10 grand for that. And then he said, can you give me $800 a month forever? And the answer to all that in his case was yes. So all of a sudden we had a guy who was hurting for cash, who was able to pay off the car, improve his cash flow that way, give the grandkids a great Christmas, and get $800 a month instead of $500 and go about his way. And in that scenario, he's probably going to still have equity left in the home by the time they pass, because they really didn't owe much and they're taking just $800 a month. So let's just call it $10,000 a year. and the house is worth 500,000. So when the time comes down the road, odds are their children will have equity in the home when they go to do something with the home, whatever they decide to do at the end. So it was like a win-win-win for all those people.
Now, you talk about the reverse mortgage itself paying the mortgage holder in a similar form to a pension. I've heard of people who will take money from a reverse mortgage and invest that money.
Yep.
That's fine too.
Yeah, and you and I touched on this yesterday, Keith. It is fine to a certain extent. So you do sign a form when you first apply for the reverse, and you sign it again at closing. And the form asks you, are you purchasing an annuity with the proceeds of this reverse? And you have to say yes or no. And if you say yes, it doesn't mean they won't allow it, but you and your advisor have to write sort of an essay as to why you're doing that. The reason is, it's not that reverse mortgages are bad. Annuities are bad. It's just that the reverse mortgage market and the government is there. Remember, these are loans for seniors only. So the government is aware that people might try to take advantage of a senior. They also know that annuities pay decent sized commissions to advisors. So that's number one. Number two, they know, and we know, that the money that comes out of an annuity when it pays you on a monthly basis or annually is a taxable income.
Yes.
Okay, comes out like an IRA. The money that comes out of reverse is tax-free. So right there, they'll want to know, why would you give up tax-free income to take a pension or annuity payout on a taxable basis? That's number one. Number two, the pension that pays out through a reverse typically is a little bit higher of an amount of money than pays out through an annuity. So again, they'd want to know why you're doing that. Now, I told you that it doesn't mean you can't do it. We had one where this happened, where the person bought an annuity, but that annuity came with some other features, like if they went into, if they needed home medical care to come into the home, or they went into an assisted living, one of them did. They would double the income. The annuity would do that. Well, doubling that income is a benefit that a reverse does not provide. And so that was a good enough reason for that person to be able to say, yes, I'm buying an annuity, and here's why, and the loan went through. So I'm not saying it can't be done, but that's just one type of investment that they have a keen eye on for. But if someone says, yeah, I'm taking all my money out or whatever I want, and I'm going to put it in Apple stock or the market, there's no question about that. They're free to do what they wish.
So one of the things that is fascinating about this is that, like, in our world, as a financial advisor, it's actually kind of like against the law for us to tell our clients to go tap the income in their property, which is kind of, but it sounds like in the reverse mortgage world, there are some backstops to make sure that that's, if you do that, then that's fine. But with the safety feature of having this insurance policy, so to speak, that provides a little bit of safety for the bank, because I'm sure the bank wouldn't be super excited for you to take that money out and then go gamble it. I do want to just jump into our poll, which is kind of interesting. How do you feel about a reverse mortgage? It's a perfect bell curve in the sense that no people said that they've only heard bad things. 20% of people said they've heard they aren't good, but that they want to know more. 60% said, I don't know enough to have a final decision. And then 20%, I've heard they're great. So, and then finally 0 said, what's a reverse mortgage? So I'm glad to know that people are at least know what a reverse mortgage is. And after that little piece, we know a whole heck of a lot more. Now, you talk about what you can access in the reverse. Could I borrow up to 100% of the value of my home?
No. That's where that actuarial conversation comes in, Taylor, that we were speaking about, where based on your age and your equity in your home, there is a limit to how much you can borrow. As a matter of fact, the most you can borrow is 75% at age 90. And the reason for that is it's pretty simple. If you just remember, the homeowner is not making any payments. So there has to be money set aside, which is in the reverse mortgage world we call reserves. It's reserved for the bank. There has to be money set aside for the bank to recoup the interest on the loan that you are not paying as a borrower. So that set aside, that reserve is there for the bank to protect them because you're not making any payments.
Okay. So help me understand this. You've got, let's just say, you took out some money. They gave you, let's say, $250,000 on a $500,000 house, so half of the value of the home.
Sure.
That's very simple. But I don't want the money, or I'm over 62 and I don't want the money. I just want to have it open. Is that $250,000 like locked in, and that's as much as I can ever get? Or does that number increase by any incremental amount over time? Or do they go back and revalue the house? How do they factor in that quote unquote 50% in this case?
Okay, that's a great question. So in your case, we're going to assume you owe nothing on the home.
Okay.
You have a $500,000 home that you owe free and clear.
Simple.
Okay. So right away when you close, first of all, I'm assuming again that you're going to choose the adjustable rate arm for your loan because that's how you get these bells and whistles like a line of credit and things like that.
Okay.
So first off, you're going to have closing costs to your loan. Let's just say $2,500, like a normal mortgage. So you're going to go from owing $0 to $2,500. Secondly, you're going to have the upfront mortgage insurance due, which is 2% of the value of your home.
Oh.
So if your home is $500,000, that's $10,000 upfront. That's where people think these things are expensive. That's $10,000 right away. Now you don't have to pay that. That will be the initial draw on your home, the closing costs plus the upfront fees. So call it $12,500. So that leaves $238,500 in your example, Taylor.
Okay.
Now, the value of your home is locked in at that appraised value on this loan.
Okay.
They don't take another look at it and say, well, now it's worth $550. Taylor's in a hot market. We're going to give him access to more money. That's why you would refinance a reverse. Okay. However, one of the beauties of a reverse that people don't know is the interest rate that is applied to your loan that they use to calculate how much you owe interest every month that goes by. They say, okay, Taylor owes us $12,500. After a month, he owes us $12,500 plus interest that is charged at the rate of the loan. Now, an adjustable rate, it's tied to LIBOR. There's a factor, and that can move. Typically, that'll move on an annual basis is how we set it. We lock it in for 1 year at a time.
Okay.
However, the amount of money that you have not tapped, so that $238,500,
okay,
also grows at the rate of the loan.
Oh.
So one of the things that happened, as I mentioned earlier, where a few years ago, the government ratcheted things up a little bit because they were worried about the program, is it used to be that if you were entitled to, let's say, $250,000 on your home, that's what you could borrow. If you borrowed less than that at the initial closing,
right,
then the upfront insurance was only 0.5%, whereas now it's 2%. If you borrowed more than 50% of what you were entitled to at closing, then the insurance was 2%. So they had two different rates for two different scenarios. Now they've changed it to where it's a flat 2% for everyone. Because what was happening is you'd have people that own their home free and clear that would just take an adjustable rate loan with a huge line of credit on it. They would pay with cash the 0.5% fee and the closing costs. So they technically had no draw on their home. They owed nothing on it. So they were not accruing any interest because they didn't owe anything. But yet that line of credit was increasing by the rate of the loan every year. So you could have a $500,000 house conceivably that you live long enough that the line of credit could be $550,000.
Right.
The day before you leave the home, whether it be for a nursing home or if you're terminal, the day or month before you leave the home, you put your request from the bank. I'd like all $550,000 now, please, and they'd give it to you.
Wow.
If people were using it as an investment vehicle, tax-free at a rate, let's say of 5%, tax-free investment vehicle, it was a pretty good deal. So as a deterrent from people doing that, it didn't stop them, but as a deterrent, they made that upfront mortgage insurance 2%. So in this case, it'd be $10,000 versus $2,500. Now to try to slow that down from happening.
So do you always have to roll it into that
No.
base, or can you?
No, that's what I'm saying. In that example I was giving you, where there's only 2,500, people would just bring it to the closing and pay it.
Mm.
So therefore, they would owe nothing on the loan, and so there would be no interest accruing.
Right.
But yet the line of credit would be growing at the rate of the loan.
Mm.
So it's a pretty savvy investment.
So right now in today's market, we're seeing things that are going crazy. Raj kind of alluded to it a little bit in his question. We're in the Denver area, and things are just going gangbusters. We're seeing companies move their headquarters here. We all just talked about this the other day. And with that, we have a very hot market. So could you conceive that a reverse mortgage actually is a great way to lock in some gains on your property if it doesn't readjust in the future, and maybe you feel like there's a little bit of toppiness in this real estate market?
Yeah, I mean, if you think that the next step is down in the value of homes, you might think maybe a recession is coming and home values are peaking, then it might be, that is a consideration as to when to do a reverse. If you think, hey, we're kind of frothy here, I'm going to do it now, versus a year from now, that would be a good reason to do it. I mean, we've had some pretty decent gains in the Denver market. They're talking about, man, over the last year, 5 to 10% again.
Right.
So if you think you could lock that in, that's a possibility. That is one of the risks, as you lock in the reverse today, and then a year later the house is worth more. But we really do reverses. We try to do it for people for more than just that reason. Right. Usually there's some other factor, like they need help financially, or there's some investment, like you and I have spoken about, whether they want to buy life insurance or long-term care insurance, or build a pension because they don't have enough income.
Right.
Right now, we all know that interest rates have been really low for a long time. And the people that are feeling that the most are people that are on fixed income, that are savers. We've seen some investments that used to pay dividends are freezing up or locking up because of COVID, and some businesses having an inability to pay. And so sometimes a reverse now can step in and fill that income void for that person that the fixed income investments are not filling.
So, Keith, go for it.
Okay, 2 questions, Lauren. First, an A or a B. If I had done the homework and a reverse mortgage was a good idea, it was necessary, it was in my best interest, would I be better off doing the reverse and not taking the money if I didn't need it? Let's assume I don't need the money right now, but it's a good idea to have it if I need it. Would I be better off doing the reverse and not taking the money, or waiting till I'm older to take the loan?
That's a fair question, Keith. And honestly, we've spoken about how if you take the loan now, that the equity line that's available grows at the rate of the loan. Okay.
Yeah.
Now, in fairness, waiting, meaning climbing up the actuarial table and getting older, typically does not generate the same amount of growth as getting the loan and letting it grow by the factor of the loan. So what I mean by that is, let's say day one you're eligible for $250,000 and you don't touch it. It's typically going to grow somewhere around 4.5% to 5% a year, based on the rate. So you're going to get that growth year in, year out. But just by going from, let's say, age 67 to age 68 and then taking the loan, that's not going to give you an equal 4.5% to 5% eligibility as to what you can get from the equity of your home. So the loans grow, because remember, I've told you that at 90, you're only eligible to get 75% of the value of the home. So it goes from like 60 to 61 to 61.9 to 62. It doesn't grow at 4-5% a year, your eligibility. So having said that, you might be better if you don't have a need for the money to do it now. But in your case, I know you, Keith, I know you very well. In your example, you have a mortgage. So the reverse, number one, is going to come in and pay that off. It has to. So the reverse has to be in first lien position. It won't come in and be secondary to a current loan. So in your case, I think your question that you asked me applies more to someone who doesn't owe any money on their home. Would I be better off doing it now or waiting?
Okay.
Because if you have a mortgage now, you're going to come in and have to pay that off through the reverse. So now you're going to owe, and you're going to instantly start accruing interest. And so that's a different story than someone who doesn't owe and may be better off waiting, or has just taking a full line of credit.
Okay, my second question, and I know little about this, and so give us the long answer. Late life healthcare expenses, unforeseen things, rising healthcare costs, confined care, all of that. Confined care at the rate of what, $75,000, $80,000 a year for a person
Right.
in Colorado now, that can go on for a number of years. How should reverse mortgages to be used to allay that fear, to allay that threat?
Sure. So we touched on the difference between a fixed rate and an adjustable rate reverse, okay, and the different features and the different ways you can take money out of reverse, whether it be a lump sum or monthly or a line of credit, and all that stuff is something that needs to be taken into consideration. However, to answer your question, Keith, let's assume the borrowers are healthy, okay, and they could pass a life insurance exam or they could pass a long-term care insurance exam. If they can do that, then one thing that a reverse mortgage will allow you to do, number one, is not take money out of other assets or other investments to purchase this type of coverage. That's number one, because most people don't want to take money out of their IRA and pay taxes on it, or they might need the income being generated from their other investments. They're living off that income and they can't trade it out for life insurance or long-term care insurance or confinement insurance. So the other big investment they have is the equity in their home. So let's talk about life insurance, for example. Let's say your home is worth $500,000 and you want to leave a legacy to your children. You'd love for them to inherit your house free and clear and get $500,000. Well, that brings in some factors. Number one, do your children even want the house? Do they have their own house? Do they live out of state? Are they in an area they love and don't want to come back to Colorado and deal with your house? Does your house need repairs that they would have to do to make it even be worth $500,000 on the open market? Sometimes parents assume that their children want to inherit this house and inherit that legacy. More often than not, when we talk to the children, they want their parents to have an enjoyable retirement. And if doing that means tapping into the equity in their home, the children are typically all for it, especially if the alternative means living with the children in their basement when their parents are an older age. So there's something to be said for that. Number two, if I can take $100,000 today and buy an insurance policy that pays $500,000 when I die because I can leverage it because I'm healthy, well, then I can use the rest of the money in my home and do whatever I want with it, use it to travel, use it to do things, and all the while knowing that my kids are going to get a $500,000 check when I die, tax-free through the life insurance. So I just leveraged the $100,000 to buy $500,000, and I can still have the other $400,000 equity in my home to do what I want to do with it, and the kids are still made whole. Same thing applies to long-term care insurance. Whether I want to do it paying a monthly or just buying as much as I can today with cash, if I could take $150,000 out of my home, maybe I could buy $400,000, $500,000, $600,000 of long-term care coverage by paying it up today when I don't need it today. And therefore, I've spent $150,000 on $500,000 worth of coverage, and I'm good. And I don't have to worry about long-term care draining all my other investments and making me be poor because I just bought a ton of coverage. And the other thing is, you guys know this, sometimes when you buy long-term care insurance, if you don't need it, they refund your money anyhow. And so the $150,000 that you put into it comes back to your family anyhow if you don't use it. So there's a lot of things investment-wise and security-wise and insurance-wise that we use reverse mortgages for that people have no idea that option even exists until they start to investigate these things a little bit further.
Which means this is not a do-it-yourself thing. No,
it really isn't. And to be honest, it's not something you rush into. Reverse mortgages are a longer process. No, I'm not speaking about underwriting. I'm speaking about, we talk to the parents, remember that there are seniors. if you do, I can't speak to everyone who offers these products, but I can speak for myself that typically I want the children at least on the phone with us to have a conversation. I want to make sure, I want to hear from them that they have their heart set on inheriting the home. You know, you asked why wouldn't someone do a reverse, Keith? Well, if grandpa built this house with his own bare hands and now mom and dad live there and they really want the kids to live there after, that's not a house you want to put a reverse mortgage on. You don't want to risk losing it to the bank when there's no equity left, when the plan was that someone from the family would inherit it and live there. So we want to get the kids involved. Okay. I had a woman, you touched on stories, Keith. I had a woman that I was helping with a reverse. She was hesitant to do it. Getting rid of her mortgage was all she needed to do. The payment was like $1,000 a month. If we could just get rid of that, she was free. And we could do that. That was a piece of cake. She had a ton of equity. She couldn't get her arms around the fact that her daughter would not inherit the home. So my answer was not to talk her out of it. My answer was, do you have your daughter's phone number? Let's call her. And we did a conference call. And the mom knew this, but lo and behold, the daughter lived in Washington, D.C., was married. Real estate in the Virginia area is expensive. They had about 10 rental properties out there in Virginia. Long story short, her daughter and her husband were loaded. They had a couple million in real estate. The last thing they needed was her house.
Yeah.
So the daughter was like, Mom, no, are you crazy? Like, you love Colorado. I want you to be able to live there and enjoy your life and not have to move in here with me and my children and my husband down the road. And if the only way you can do that is to access the equity in your home, please do. Do not worry about me and my kids and my husband. We're well off. And as soon as she heard that, she was like, done. Where do we go?
Wow.
I love that.
In most cases, your kids don't want your house, right?
Well, they don't necessarily want to move in. Okay. Most of the time, most of us, our homes are not every day ready for sale, right? There's things there's touch-up painting and maybe painting, and there's repairs that have to be made. You have to hire a realtor. You may have to fly back to Colorado to deal with showings and letting people in the home, or there's just a lot that goes into it. Even if you don't want the house, selling it can be a pain.
Yes.
So if you can replace the value of that home with like an insurance policy so that the kids are getting the money anyhow. But even if you can't, the kids most of the time will say, I'd rather you enjoy retirement. You did a lot for me as a child, maybe put me through college, maybe didn't, whatever. You raised me. You've done a lot already. Enjoy your glory years. And if the only way you can do that is to get the money out of your home, please do, rather than being cash strapped and potentially having to move in with us in your later years. And the parents think they have to leave a legacy, and that's not always the case.
I love it. That's so good. I want to just remind our listeners and our audience, if you have questions, use the chat feature to plug it in. Raj asked a really good question earlier. Lauren's just a wealth of knowledge, and we've covered a lot of topics, and we've kind of just scratched the surface on this, and it's been very, very helpful to get that some of the understanding. And I love the stories. I've got to ask you, for those that are watching, have you explored how a reverse mortgage might impact your financial plan? So I'm going to publish that poll right now. I'd love to hear your feedback. Have you explored how a reverse mortgage? We clearly got a question from one of our audience members that's already utilizing a reverse mortgage for their financial plan. Have others looked into it? And number one, is it you looked and it wasn't a good fit, or you looked and it might be a good option, you still haven't made a decision, you don't know, or the last option that you have here is you don't have a financial plan, in which case we need to have a conversation, and a very real conversation. So I'd love to hear your feedback on what your experience is with a reverse mortgage as it relates to your financial plan. One of the things that we definitely want to focus our efforts on is doing comprehensive planning. And this is definitely a piece, is this cash flow. There's something that we've talked about a lot is, Lauren said, these people had a gap in their income, and just by reducing or eliminating their mortgage, all of a sudden that changed the entire landscape of their retirement. So I love that story. Lauren, question here. We've talked about some of the myths, touched on them. There's a couple that come to mind. Number one, You can get kicked out of your house. We touched on that with, splitting the mortgage. You can't sell it, or you couldn't buy a new home, or the inheritance issue that we just talked about. Can you touch on those? And I'd be happy to repeat that.
Yeah, no. So we touched on the getting kicked out thing, and it's not just a matter of the ages. Okay, it's not just a matter of one being younger than the other.
Yeah.
When the loan goes through, there are reverse mortgages. The note has what's called covenants that you can't violate. So you have to pay the property taxes. Okay, because property taxes become a lien, and that lien goes in front of the reverse mortgage. So the mortgage company is not going to allow you to have a lien fall in front of them. So that's another reason we get the children involved, is we want to make sure, especially here in Colorado, that the tax bill, when it gets mailed out, there are no escrow accounts on reverse mortgages. So most of us are used to paying our mortgages through an escrow account. But because, remember, you're not making any payments, so there can't be an escrow account because they're not collecting any money from you.
Yep.
So you have to pay your taxes on your own. And so we want the kids to know that. We want the kids, and I say kids, most of the time these are people in their 40s, 50s. We want them to contact their mom and dad every year and say, hey, I know property taxes in Colorado are due by the end of April. Have you made the payment yet? And if they haven't, in a worst case, the child can go make the payment at the county for them and get the money back from mom and dad. But that has to be paid. Number two, you have to pay your homeowner's insurance. It makes sense. You have to maintain insurance on the property. Okay. The number three thing you agree to is that you'll treat it as your own, meaning that you can't have gutters hanging off of it. If there's a hailstorm, you have to fix the roof. You can't let the bushes grow up to the roof. Like, you have to keep the property upkeep. Okay. That's number three. And number four, it has to be your primary residence. Reverse mortgages at their core are FHA loans. FHA loans do not, whether they be forward loans or reverse, do not lend on investment properties. It has to be your primary residence. So they do check in every year to make sure you still live there. You have to sign an affidavit that says you do, and then you go about your way. So that's the getting removed part, Taylor. Was there more to the question?
Yeah. So then this buy sell conversation.
Oh yeah.
When you do a reverse, you're stuck, and you're like, well, I better like this house. And if you're in your 60s, you could be living that house for another 30 years.
That's right. So number one, that ties back into the fear or the misnomer that we talked about earlier, where the bank takes ownership of the house. You are the owner of the home always. You are the ones on title. The bank becomes a lien, just like any other mortgage you may have. And that lien can be paid off whenever you want, as long as you have enough equity. Okay. So if you have, now I would not remember, there is a 2% of the purchase price fee at the beginning of all reverse mortgages, okay? So if someone came to me and said, Lauren, I want to do a reverse mortgage, but I might not live here in 2 years. I don't want to do it for them because I don't want them to pay that big fee and then walk away in 2 years. It's a waste of money, okay? Now, having said that, plans do change, right? A child might get ill. You might decide that you don't want to be in Colorado anymore and you want to be closer to the grandkids. Right. All good reasons. At any point in time, there's no prepayment penalties on reverses. They can be paid off at any point in time, and you can move on. Now, if you take it out when you're 60 and now you're 88 and you want to sell, you can sell, but understand you might sell your house for $500 and you might owe $520. So you got to have the money to pay the bank off. You've got to have that extra cash. But at any point in time, you can pay off a reverse mortgage. It's no different than any other mortgage. You just request a payoff, send them their money, and the house is yours. Now, one other thing I'll add about inheritance and children. One benefit of a reverse mortgage is, let's say mom and dad owe $500 and the house is worth $500, and they are now leaving the house. They've either both passed or they're both in assisted living, but the children want the house. The reverse mortgage company will sell the house to the children for 95% of the appraised value at that time. So if the house is worth $500 but they owe $500, the children can buy that thing for $475 from the bank, and the bank will take that loss on the insurance policy. If you owe $550, they'll still sell it to you for $475 if you're the heirs. So there is a way to keep it in the family, even if it's upside down, based on the parents living a long time. So I wanted to add that too. But you can sell this house anytime you want, Taylor.
That's amazing. So we kind of talked about this offline when we were preparing for this, but when it comes to planning for Social Security, one of the things that we know is Social Security provides that 8% bump from full retirement to age 70, and there's that sticky point that 66, 67 is oftentimes when people want to call it quits. Could a reverse mortgage maybe be a good way to bridge that divide where you want to delay your Social Security? Because that's what it comes down to, is cash flow, and retirement is really important.
It could. You'd have to do some careful planning there because, number one, remember, they're going to pay off your mortgage if you have one, Taylor, right? And so you're going to start immediately having interest accruing on you, maybe not to the tune of 8%.
Okay.
And then every month you're going to owe more and more and more in the house to where it starts to build, right? And so if a simple reason is to just get those 3 years of kickers or 4 years of 8% growth on your Social Security, we got to be careful there, because if you owe $300,000 in the house and they pay it off, now you've started this cascading of negative interest that's going to accrue, and it may not be the right thing for you long term.
Okay.
Just to get the 8%. So it's a possibility, I will say, but it's not a slam dunk. We have to look at each individual situation carefully.
Lauren, a question that goes back to the fundamentals. And I think I know the answer to this. I think you already answered it, but I just want to make sure. Can you ever end up owing more than you borrowed, or more than your house is worth?
And actually, that's what I call winning the deal. I mean, you can live long enough, absolutely, that you owe more than it's worth. But this is where, and I'm glad you brought this up, Keith, this is where we spoke about a little thing yesterday. The term is called recourse, okay? In a regular forward mortgage like that we're all used to, if we don't make the payment, we go into foreclosure, they can kick us out of the house. They technically have the right to come after you and garnish future wages or seek payment. They have that right to do that. You don't see it very often. During the recession of 08 and 09, President Obama made an executive order that made them not able to come after people for non-payment, okay? So you had a lot of people going into foreclosure, even on investment properties, and they knew that there was no recourse that was going to come after them. One of the reasons that Canada did not have the same foreclosure crisis we did is because their mortgages are fully recourse. So if they don't pay, they'll just dog you on future jobs, and they'll garnish your wages, and they'll come after you in other ways. So they didn't have people just saying, I can't afford it, I'm walking away. In America, we did have some of that, unfortunately. But in the reverse mortgage, the contract is between the bank and the house. A forward mortgage is a contract between the bank and the borrower. Okay? There's a note signed at closing, a promissory note. On a reverse, there isn't. The reverse is a contract between the house and the bank. So yes, you can end up owing more than it's worth, and that's okay, because it's non-recourse when you leave the home. And if you leave the home under the correct terms, I'm not talking about selling it. If you owe more than it's worth and you just try to sell it, you owe the whole thing. Okay, you've got to come up with the extra cash. But if you leave under the terms of the reverse, meaning you die, or you go into a nursing home or assisted living, or have to move in with the children for home health care, that's okay. But you're leaving the home on a permanent basis, you do not owe the difference. So if you owe $550 and the house is worth $500, you don't, your family, your estate, nobody owes that extra $50. They don't owe the realtor fees on top of that and the closing costs that are going to come from selling the property. Those losses are all taken by the insurance policy that you bought up front when you did the loan, 40 years earlier, 30 years earlier.
Absolutely.
So this is an amazing conversation, because I think that where there's lack or a gap in knowledge, there is fear, and that has been the biggest thing that I've taken away from today's conversation. Is these are not financial instruments that should be quote unquote played around with or speculated with. It takes a lot of planning. It takes a lot of consideration. And one thing I don't think we talked about is that you actually have to talk with a specialist, or somebody with the FHA or something like that, right?
It's a great point, but yes. So what happens is, the rule is that someone like myself can meet with you about a reverse mortgage. We can discuss everything. but at the end of the day, I'm going to be compensated for doing that loan.
Mm-hmm.
And so what the rule states is that you have to have about a 45-minute conversation, can be in person or on the phone, with a certified reverse mortgage counselor who does not get compensation for the loan. They're totally independent, and they will walk through the pros and cons of a reverse and make sure that you're a good fit. And then they send you a counseling completion certificate, and I cannot start the loan until you give me that certificate.
So again, just there's a lot of things and ways to protect you as the borrower or the reverse mortgagee, to make sure that you're making the right decision and that you're not making it in haste, and that we know that Lauren is a very good businessman. He's going to do things by the letter of the law. But unfortunately, there's some folks that are out there that are not quite as stand up. So making sure you understand how it works. But more than that, making sure how you understand it works in the bigger context of things, not just on the reverse itself, but don't make that decision in a silo, but make it from a holistic perspective. I'm looking at our final poll, and it looks like about 60% of you don't know how a reverse mortgage might impact your financial plan. And we would love to be able to have that conversation with you and provide some deeper knowledge and deeper experience on what we've seen with our clients. I will say, not all of our clients have a reverse mortgage. It's a case-by-case basis. It's not like, oh yeah, here, you get this, and then you get this, and you get this fixed set of products when you work with us. We're going to cater and customize your plan specifically to your life and your lifestyle, your income needs, all your other assets. So if you want to connect with us, use the offers tab. That will then send you to our website. You can schedule a one-on-one call with one of our advisors. It's usually going to be either myself, Keith, or Lauren, and we would love to connect with you to help you understand how it might impact your financial plan, and even go deeper than that, how all of the investments that you have, how Social Security works, if you've got pensions, if you've got other income in retirement. Those are some things that we can help with. We're excited that you joined us today. Next week's episode, we are going to have Kevin Heipel on there. He is he's a former assistant attorney general. He's written numerous books. He was an attorney that worked on bankruptcies, and we're going to dive into the bankruptcy world, the entrepreneurial world, his experience as an assistant attorney general. It's going to be an awesome event next Thursday. We're really excited. Lauren, we thank you so much for your time today, and hopefully we can have you on here again to learn a little bit more, because I think we just scratched the surface.
I agree with that. It's been great. I love talking about this stuff. It's exciting, and but you're right. It is part of just one component of someone's overall financial plan, and we do take it carefully. It's a long process. It's a long conversation, and I'm happy to have it with anybody. And I look forward to doing this again with you guys.
Lauren, two things. Just reiterate, best way to contact you if people have further questions, and I'm sure there are a lot of further questions. And then secondly, if you would leave us with one most important thing to remember from this conversation, what would it be?
Okay, so the best way to reach me is, I have an office here with you guys, but I'm working on loans and mortgages all the time. So my cell phone is 303-880-8881 is probably the best way to reach me if you have questions. The one thing that I would leave with you is to always maintain an open mind. There are, I talk about annuities, as you guys are aware. There are people out there who just think annuities are bad. There are other people who think they're great. And the truth is, they're neither. They're not bad or great. They're somewhere in between, depending on the right person. They might be bad for one person and great for another. Same thing with reverse mortgages. Anytime you hear that something is terrible or awful or, oh, I would never do that, the product exists for a reason. And the reason is that it's right for a lot of people. It's not right for everyone. And understand that and keep an open mind. And if you want to just have a conversation, the one thing that I can vouch for is myself, that if it's not right for you, I'm going to tell you. I'm not going to try to get you to do one, because I don't ever want buyer's remorse. I don't want ever someone coming back to me or my firm to say, what did you do this to me for? I always want to make sure that you walk away as happy as can be with a revolutionized financial plan or income stream or life. So just keep an open mind is what I would say.
Lauren Levy, thank you.
You're welcome. Thank you.
And send your suggestions, your questions, and suggestions for future Eagles Nest webcasts to webcast@presidentialwm.com. For Taylor Leary, I'm Keith Weinman from Presidential Wealth Management.
Presidential Wealth Management securities and investment advisory services are offered through Forta Financial Group, Inc., a registered broker-dealer, member FINRA and SIPC.